Intuit, Salesforce, Adobe, ServiceNow, Workday. Every one of them beat or raised on its most recent report. Every one of them is down between 35 and 55% this year. Salesforce beat earnings by 24% and posted a record operating margin. ServiceNow beat the top of its own guidance range. Adobe beat consensus and raised its full-year target. Intuit raised guidance on every non-GAAP metric it reports. Together these five generate $39 billion of free cash flow a year. Combined, they've lost more than a third of their value. So the market isn't trading the last quarter. It's trading the next 5 years. I'm Big Z, and this is part 2 of 3. In part 1 I argued the market is pricing one variable, what your revenue meter counts. Seats shrink with AI. Compute and machines grow with it. And the specific mistake I identified was the assumption that a seat-metered company cannot change its meter. So this episode doesn't ask, did these stocks fall too far? That's unanswerable. It asks something you can actually check, can each company show its meter moving, in units it discloses to investors? Not a slide about AI strategy. Not an executive saying agentic. A disclosed number, in a unit that isn't a seat, that got bigger. 4 of these 5 can. 1 can't. Let's go in order of how strong that evidence is. Start with ServiceNow, because its disclosure is the cleanest. Second quarter subscription revenue, $3.88 billion, up 23%, and it beat the top end of its own guidance range by 150 basis points. Then the meter number. AI annual contract value passed $1 billion, tracking ahead of the company's own $1.5 billion target for year-end. Agentic deployments are up 9 times in 9 months. 123 deals over $1 million in net new contract value, up about 40%. Renewal rate, 98%. But be honest about the price. At 19.7 times forward earnings and 7 times sales, ServiceNow is still the most expensive of these 5. It isn't a cheap stock. It's an expensive stock that got derated, and that's a different thing. Salesforce gives us the single best meter change disclosure in enterprise software. Revenue $11.13 billion, up 13%. Earnings of $3.88 against $3.12 expected, up 50%. A record non-GAAP operating margin of 34.8%. Now the units that aren't seats. Agentforce recurring revenue, $1.2 billion, up 205%. Underneath it, 28.6 trillion tokens processed, up 152% quarter-over-quarter, and 3.8 billion agentic work units, up 111%. Tokens and work units are consumption. That is a company changing its meter in public. And here I have to be precise, because both headlines you read were true. Salesforce raised its full-year guide, versus its own prior guide. That same guide came in below Wall Street's number, and next quarter's revenue guidance missed. Raised versus itself, light versus the street. The stock fell on the second one, and that was fair. Adobe is the cheapest name in this group and the most misdiagnosed. Revenue $6.62 billion, up 13%, against consensus of $645. Full-year target raised. It trades at 8.2 times forward earnings with a 35% operating margin. On the meter, AI-first recurring revenue tripled and crossed $500 million. Firefly approaching $300 million on its own. And the number I'd point at hardest, Creative freemium monthly active users crossed 90 million, up 70%. That is explicitly not a seat funnel. So why is it down 36%? Partly AI fear. Partly something with nothing to do with AI. Adobe's chief financial officer left effective June 15, 4 days after that report, while the company was already searching for a chief executive. 2 top-level vacancies at once. That's a real discount, it just isn't the discount everyone thinks they're taking. Intuit has the strongest fundamentals here and the worst stock. Down 55.3%. The quarter, revenue $8.6 billion, up 10%. Assisted tax, money, and mid-market each grew north of 30%. TurboTax Live customers guided up 38%, revenue up 36%. Raised guidance on every non-GAAP metric. a 47% operating margin, highest of the 5. Now the part 1 won't spin. Intuit's fastest growing lines are Assisted Tax and TurboTax Live. Those sell more human expert hours. A genuine strategy, but not a meter change. It's the opposite bet, that people will pay for humans in the loop. Meanwhile, Intuit cut 17% of its workforce, about 3,000 roles, with a $300 million restructuring charge, and called it an AI-focused reorganization. Strong company, cheap stock, strategy pointed away from what the market is repricing. Those three facts have to sit together. Workday is the one that can't pass the test. The quarter is fine. Subscription revenue $2.35 billion, up 14.3%. 12-month backlog up 15.5%. Best first quarter bookings growth in 5 years. Gross revenue retention 97%. Nothing is breaking. But go looking for the meter and there's nothing there. No AI recurring revenue. No AI contract value. No consumption unit. No disclosed non-seat metric at all. Of these 5, Workday tells investors the least about whether its meter is changing. Be careful with that, it's a disclosure gap, not proof of failure. They may be converting and not reporting it. But when the whole debate is whether your unit survives, silence is a choice, and the market is pricing the silence. It's also the slowest grower here, selling software priced against headcount, in an era when its customers are cutting headcount. Now the fact that should keep you honest in both directions. Not one of these 5 has printed a seat decline. In part 1, the cleanest evidence in the entire market was Atlassian disclosing that enterprise seat count fell for the first time in company history. That's what a real break looks like. None of these 5 has shown it. ServiceNow renewed at 98%. Workday retained 97%. Salesforce posted a record margin. Adobe and Intuit both raised. But run the same sentence backwards. Atlassian's own prior quarter gave no warning either. Retention and renewal describe contracts signed before agentic AI was deployed at scale. They are lagging indicators, every one of them. So the absence of damage is real, and it is not the same as proof of safety. Here's my ranking, and it is ranked by evidence, not by how far each one fell. 1. ServiceNow, strongest disclosed meter change, and it beat its own guidance. Most mispriced relative to what it has shown. Caveat, still 19 times forward. 2. Salesforce, the token and work unit data is the hardest proof in the group that a seat company can convert. Mispriced on the meter, fairly punished on the guide. 3. Adobe, real AI revenue, 90 million non-seat users, 8 times earnings. Mispriced on AI, correctly discounted for governance. 2 problems wearing one price. 4. Intuit, best margins, cheapest against profitability, but the growth engine sells human hours. Strong business, strategy aimed elsewhere. 5. Workday, no disclosed meter, slowest growth, priced against headcount. Closest to a genuine value trap of the 5. That's my judgment on disclosed evidence, and here's exactly what would change it. A ranking you can't falsify is just an opinion. 3 things I'm watching. 1. A seat count disclosure. If Salesforce or Workday discloses a sequential seat decline, that reorders this list immediately and moves Workday from value trap to something worse. 2. 20% growth. The cohort the market rewarded grows 25 to 33%. This cohort grows 10 to 24. 20% is my line, and only ServiceNow clears it. Any of the others crossing it re-rates. 3. ServiceNow's own target, $1.5 billion in AI contract value by year end. It's past $1 billion now. Hit it, and the meter change thesis has its first company set, publicly confirmed proof point. Miss it, and my number 1 drops. Before I close, the strongest argument against everything I just said. Every one of these 5 grows slower than the names the market bought. CrowdStrike at 26%. Palo Alto at 31%. Datadog at 32%. Cloudflare and Snowflake at 33.5%. A 10 to 24% grower does not re-rate because it's cheap. It re-rates when growth turns. And cheap is exactly what a value trap looks like from the inside. Adobe at 8 times earnings is either the best risk-reward in large-cap software or a company whose terminal value is genuinely lower than it was 2 years ago. Both stories fit an 8 multiple. The disclosed evidence is what separates them, which is why I ranked on evidence rather than on price. That was part 2 of 3. This series is called Software's Great Sorting. Part 1 was the diagnosis: the market is pricing what your revenue meter counts. Part 2 was the verdict on the 5 megacaps it condemned, 4 with evidence, 1 without. Part 3 goes to the other end of the stack: why building software got radically easier and the software business got radically harder. AI-native applications reaching hundreds of millions in recurring revenue in under 2 years, and churning 30% faster. And the question that matters for a US investor: when the fastest-growing applications are all private, what do you actually own? Part 2 of 3. Follow so Part 3 finds you. I'm Big Z, follow me, see you in the next deep dive.